I'm going to be now bringing on our next presenter. He's actually goes by the name of Larry Gaines. Now, Larry here is coming up, and he has over 30 years of professional trading experience. In over 10 years, ran the international trading desk for one of the largest oil trading companies in the world. Larry uses a top-down market technical analysis combined with price cycle trading module. He also integrates it with options and futures. He will present to you with information relating to his proven price cycle trading system that has been able to generate outstanding profits ranging from 5 to over 100% in 1 to 5 day periods. Without further ado, ladies and gentlemen, here is our next presenter, Mr. Larry Gaines.
Let me just get set up here, and thank you very much for having me today. Just 2 seconds while I do this. And let me get my audio view so I can see what you guys are seeing, because I'll have some live charts too. Anyway, you should be seeing an upside down dog. Can everybody hear me loud and clear? And excuse me for my throat clearing there. I'm just trying to get set up and organized. Just give me a minute. Okay, thank you. Okay. All right, so let's get started here. And again, thank you for having me here this morning, and thanks everybody for showing up. It's really great to be in here on a Saturday morning, and it's beautiful here in Austin. I don't know where everybody is, but I'm sure you're from all over the country and other places far about. So let's get started. First off, this webinar today is purely educational, and any stocks or futures that I'm talking about should not be taken as advice and not construed as recommendations. So again, I've been actively trading and a professional trader for over 30 years, and for over 10 years ran one of the largest oil trading desks in the world for crude oil trading, and we also pretty much expanded out to trade pretty much everything from foreign exchange to every futures market out there. So great learning experience for me. And then in 2009, I launched an institutional over-the-counter brokerage desk for the largest privately owned oil brokerage company in the world, and it was an over-the-counter option desk for crude oil. So, I just didn't set up shop yesterday, so I've been doing this a long time. And back in about 2010, 2011, I started teaching and mentoring different people and traders, and from there just kind of grew into more educational type of service. And from that point on, I've been pretty much doing, you name it, I've been trading weeklies and futures and everything. We have a company, powercycletrading.com. But what I'd like to do today is ask yourself this: what if you could add a new income stream now? Could it change your life? And if the answer is yes, then you have a plan to achieve that. Well, the plan I'm going to show you today is for option income success. And first off, we'll go through how not to lose money trading options for income, why your broker won't let you trade options, the components that every option investor must understand, the most important option factor for income generation as a goal, and income strategies for every market. So first, you need to understand, have a concept to understand what option risk is. And I like to use options. That's kind of, I started trading options back in about 1986, 87, and on cargoes of crude oil. And when it first came out, we didn't really understand options at all. I didn't have a clue. I just knew options gave you options. And we had the old Black-Scholes model, which is still used today, but now everything's so automated you don't even need to put anything into the model yourself. But it was a good learning experience because you learn from the bottom floor down. But risk is the key thing to understand on pretty much anything you're trading, in options specifically. As you know, derivative trading such as options comes with risk. As a trader or investor, you must hold yourself accountable for your trading decisions, and you must understand the risk involved with strategies you choose to use. You must know how to defend a trade gone wrong. The best way to do this is through education and to learn from others with more knowledge and experience. So, learning from somebody else that's been there, made the mistakes, and seeing a lot of the things that can happen will shorten your learning cycle, your learning curve, and hopefully help you to avoid those same mistakes. And I've made plenty, believe me that. Step 2, why your brokers won't let you trade options. Well, when options first started, being traded and talked about, traders or investors, when they would lose money or a trade would go wrong, they would start, pointing their fingers at the broker, blaming them for allowing them to take more risk than they were qualified for. And many brokers, because of this, many brokerage companies got in a lot of trouble with the SEC and other authorities about this. So as such, all option brokers now have since started a risk assessment of all new account holders in order to determine the amount of risk they're suitable to undertake. And different option strategies will have different risk levels. Now, trading levels were created based on this relative riskiness of each class of option strategy. Option approval levels now, they're basically 5 levels, but most strategies can be done with levels from 3 or 4. At a level 3 or 4, traders can use a variety of strategies like straight calls and puts, as well as more complex trades such as spreads and credit spreads. And these are also acceptable levels even in your IRA accounts. And some brokers will have fewer restrictions than others, so you really should, before you, if you're already trading options, then you're probably set. But if you're not, but still, you should check around to different brokerage houses and see what their restrictions are. You might be missing out on some great opportunities because the current broker you're using now perhaps won't let you do a certain strategy. So check around. Step 3, the option components that every option investor must understand. The thing is how to value an option. So first off, you want to know, what creates the value of an option. Well, the value of an option is very simple and straightforward, really. It's just time value times its implied volatility times the intrinsic extrinsic value of that option. So step 4, what's the most important option factor for income generation as a goal? Well, this is a key right here, time value. Time value is used for trading strategies that take advantage of the accelerated time decay of an option into expiration. Option income strategies are very tied to time value and the impact it has on the price of an option. So this is a key component for if you're doing any kind of income strategy, you're going to want to really take into account time value and how that works and how it affects the various strategies that you're looking at. So what is time value? Well, if you're not familiar with it, it's the extrinsic of an option. It's the premium a rational investor would pay over its current exercise value, the intrinsic value, based on its potential to increase in value before expiration. This probability is always greater than 0, thus an option is always more than its current exercise value. So time value is one key component. There are all these different Greeks that you may have heard about, maybe you haven't, but if you're looking at income and income option strategies, this is one of the key components that you need to understand. It's not that difficult. I'm going to go through some examples and things like that to show you, get you better, get you more familiar with it. Time value can also be thought of as the risk premium the option seller charges the buyer. The higher the expected risk, volatility plus time, the higher the premium. Conversely, time value can be thought of as the price an investor is willing to pay for a potential upside. So time decay, it's exponentially to 0 at expiration. With the general rule, it will lose about 1/3 of its value during the first half of its life and 2/3 in the second half. As the option moves closer to expiration, moving its price requires an increasingly larger move in the price of the underlying security. So here's a time graph just to kind of illustrate this. So basically, when you start out, here's starting from 120 days out, and you can see the slope is more gradual. And then you get into the next period from 90 to 60 days, and then from 60 to 30. And this is where it starts really accelerating. You can see how it really, the decline is just really steep, like, like going over a waterfall. So then from 30 days down, that's kind of the sweet spot of where you get the time decay, and it eventually goes to zero. So this is a key concept to understand for your option trading and to know which strategies to use in order to take advantage of the various parts of time decay, the various places that you are within time. Now this next chart will show you just the time graph for a weekly option. And weekly options are something that give you accelerated time decay. And if you know how to use the weeklies correct, there are all kinds of different opportunities that you can have in your trading to take advantage of the weekly options. The weeklies come out each Thursday, and they'll expire 8 days later. So each day, the time decay is about 1/8, or about 11–12%, and then you see how it just goes to zero. Now this next table can illustrate it even a bit further for you, and I'll lay this out. So if you're not at all familiar with time decay, this will really, I think, bring it together for you. Let me get the pen out. So here, this is the table to outline it. Here's your option value. It's that time times the implied volatility times that intrinsic extrinsic value equals your premium right here. So if you look at Thursday when that weekly option comes out, you can see I put it at 1, represents 100% time, and then I just kept the implied volatility at different levels. I just put these in to show you how it relates, and I kept the intrinsic value just a constant of 1. So that first day you come out 1, you have 100% time times that implied vol, kept this at constant, so you have a $300 premium there. That's your premium or your value. Now you can see the Friday it goes down 1/8, Saturday another 1/8, over the weekend it decays. Then Monday you come in and it's down to 50%. So even when implied volatility, I jacked this up to 800, you can see kept that constant. You can see that your premium only went to $400 right there. So time value or time decay, you can see how it really creeps in and has a tremendous effect on price. So if you understand this concept, then there's certain things and certain strategies that you can use to take advantage of that and have it work to your benefit. Step 5 is selecting the right income option strategy. So there are a bunch of different strategies, and all have different benefits and factors that are good and some factors that are maybe not so good. And so we're going to go through those today so you can kind of have a broad brush look at the ones that are out there that perhaps you would like to look at further. So the basic strategies, you probably heard of covered calls. And let's see a slide. I'm looking at the screen. There it is. So the basic income strategies are covered calls, calendar spreads, diagonal spreads, condors, long-on condors, and credit spreads. So we're going to go through these and show you the differences and show you some of the things that can really are interesting about these various income type strategies. Income, we all need income, and with the current ups and downs in the markets and the various situations we've been through financially over the past 10 years or more, a lot of us, me included, have lost money in the markets when we've had these tremendous crashes. I remember in 2008, in 2009, when I was running this brokerage desk, I had various stock portfolios and stuff, and it wasn't pretty when that 2008 scenario happened. So you need to be prepared for these things, and there are different types of strategies that can help you with any market condition. So the first one, will be just covered calls or covered puts. So this is strategy 1. Now this is the most basic writing stock options kind of strategy, and it's a great one for monthly income. Writing stock options is a basic component of the strategy. And when writing stock options, the premium from the sale is deposited straight into your bank account the next business day. You keep that premium regardless of what the stock does, and that's that's the income that comes into you, just like a rental house that you might own, or properties that you have that you collect rent from go straight into your bank account and you still own the underlying. Now, stock options times compounding equal wealth. Now, cash from writing stock options can be compounded into great wealth. And those who understand how to take a 5% gain monthly can make themselves rich. You can see the incredible wealth building power that those numbers can create. And most investors simply purchase stocks with hope it will increase in value. And while stock option writers, you have what you're looking for is that you're getting to increase your return significantly based on that underlying that you own. So you're not really concerned with the stock itself. You're more concerned with the income you're bringing in from it. It's a vehicle for you. And stock options, these can be done in your IRA account. Writing stock options is safe enough that covered calls are approved for your IRAs. And using stock option strategies for income can really help make up for those years when your retirement nest egg didn't grow at all or didn't grow fast enough. So we are all, kind of in that situation where we're looking to the future, and we need, income. We need to supplement what we currently have, and we need to plan for that future. So the next thing is covered calls versus covered puts. When the market is strong, we want to write stock covered call options, but we want to treat those stocks that we own as a commodity for this type of strategy. We are looking to generate monthly type incomes from that stock that we currently own. It's not that important to want to own the stock. The options are written against. It's you more so taking the advantage of the stock being called away. You actually want that stock to be called away because you want the income. And that means that the stock was going in your favor and the strategy was working. It's important you like the stock's short-term potential and you select a stock that's going up. So that's the hard part of this strategy. Number one is stock selection. But just quick example, if you are doing this strategy on a monthly basis in your self-directed IRA, 5% gain, if you took $978 investment, you could grow that to over around $340,000 in 10 years on the compounding. Now, in contrast, if you took just a bank yielding 2% interest, which is difficult to even get today, it would take you 100 years to reach that goal of $300,000 or so. So, this is one strategy to be considered for a retirement account or for income. So it's one strategy to look at. Secondly, though, writing stock covered call options can be a great source of income when the stock market's going up. But what about when the stock market's falling? Well, we've all seen that enough times where, it just kind of makes you sick, right? So what you can do if you're still wanting to go to this strategy is, number one, you can sit on the sidelines and do nothing. But if you're looking for income every month, then you need to figure out a way to still incorporate this strategy if this is the one that you're going to use. So what you can do is when the market is weak, you can do two things. You can write stock covered put options, and all this is you're writing a stock covered put option allows you to profit from a declining stock market. With the stock covered put option, you have already sold a stock short, so you don't have to care about if it drops, and then you're just selling a put against it. So it's just kind of the reverse of a covered call. Now, the other option income strategy is to use in a weak market is to write covered call options on inverse funds or bear market ETFs. And this is a great one. I was doing a lot of this actually in 2009, and it worked out really great. So, and there are a lot of different inverse ETFs that you can use. And here's a list of these strategies, or not strategies, but some of the ETFs that you can use. So for the QQQ example, you can use PSQ. One of the really good ones, really tight bid spread, bid ask, is the ultra short S&P 500, this SDS. This is an excellent one. And also the TWM, this is going to be a great one, the Russell 2000. So here's a list of, these that you can, look at, and it gives you a great underlying instrument to use to write options against when the market's moving down. And there are even sectors that you can use. So you can do this in ultra short basic materials, SMN. You can do industrials, real estate. So pretty much with all the ETFs today, there's a lot of different areas that you can go to and a lot of good tools out there for you. So if you're not familiar with covered calls, here's just a basic example of it. And I'll go through the other ones too after this. But say Joe owns 500 shares of XYZ stock that he bought for $40 a share. And he's tired of that 2% annual dividend, which is getting him nowhere. So let's say on February 20th, Joe sells 5 March call options with a $42 strike, 42.5 strike. Now he owns the stock at 40, remember? He was able to collect $1 per contract. Now remember, one option contract is equivalent to 100 shares of stock. So Joe gets that 500 in his brokerage account for selling those options, which is 2.5% return in 5 weeks. Well, that's a lot better than that 2% yield he was getting annually. Now, what happens though here, Joe is basically what this means is that Joe has given up the right to the buyer of that call option to buy the stock on the 3rd Friday of the month or before at $42.50. Now, here's what happens on expiration Friday if the stock went to 42. Well, if the stock's at 42, he's not going to get exercise, so very less chance of that 42.5 call being exercised. And the bottom line is he's going to get to collect and keep that total $500 premium that he collected. That was $1 per contract. So that's a pretty sweet deal. That's just your typical covered call. And then the opposite though is what if it goes to 43 over his 42.5 strike? Well, you can just close out that option that you'd sold. And so in this example, because of time decay, he could have bought it back for 50 cents. And so his initial premium, he received $1 right there, less the 50 cents that it cost to buy it back, but he still kept 50 cents or $50 a contract. So based on this strategy, he would have still made 1.25% in that 5-week period, and annualized that's over 10%. So again, this beats that 2% a year. So that's your basic covered call strategy. And it's a good one, and a lot of you probably still have portfolios of stocks, so you should look through your portfolio, see what stocks are sitting there that you can write calls on, and take advantage of it. Don't let it sit there as an asset that's doing nothing for you. So that's something to keep in mind. Now this is what it looks like on a graph. Here's you're selling that premium here. Now the stock potentially can go down, so that's the downside risk. Plus this thing costs requires a lot more capital. Now the second income strategy that is pretty popular is the calendar spread. And basically the calendar spread is a neutral option strategy that profits when the underlying stock remains stagnant or trades within a tight range. And a counter call spread profits primarily from the difference in the rate of premium decay. So here again, that time decay factor is something that you're working with on a calendar call spread. So what you're looking at is the decay between the near-term short option and the long-term option, or leaps in some situations where you're out even a year, or you could even go 2 years out. Now this is possible as the near-term option premium, remember, will decay faster. Remember that time curve than the long-term option premium. So that's the concept that you're capturing. So here again is that chart, that graph. So basically what you're doing is you're going to be buying, your underlying option here and selling a current or closer in option there, and it's a kind of a horizontal strike. They're both at the same price level. So when to use a calendar spread? You should use a calendar spread when you expect the underlying asset to stay stagnant or within a fairly tight kind of trading price range. It's also useful to use for market conditions when you want to keep a long-term call position for a particular stock or ETF that you're expecting maybe to have a potential nice move to the upside in the future. So it's a good one to use if the market's kind of flat, but you think it's potentially going to have a move to the upside, and then you can sell that front end call against it and collect income off of it, and also potentially gain from the market moving up. And you can do it over and over, so you can optimize it and do it more than one time. So here's a quick example, just kind of illustrate this. So let's say here you're long a 38 call, so April. Okay, we're currently in February. So you go out and you buy an April 38 call, and then you immediately, at the same time, you short a March 38 call. So see, it's horizontal, so it's a 38 and a 38, same strike. So these are put on as a debit spread, so it's nice because you have defined risk. Defined risk. You don't have to worry about getting run over with the market crashing or whatever and having to make adjustments. You don't have to make any adjustments, And these are, there are two things to also understand when you're trading, is how much time do you have, to put forward and to manage your trades, manage the risk. So you as a investor or trader or whatever need to look at your lifestyle and determine how much time do you have, and then pick the strategies that potentially can work to go in to benefit from your time constraints. Maybe you're working, maybe you don't want to sit at a screen all day and do adjustments on a credit spread that's gone bad or something like that. So you can look at other types of strategies, and this is potentially one that you might want to look at. So it's defined risk. Once it's on, it's a debit. So it takes advantage of the fact that options in different time frames will decay at different rates, which we kind of briefly touched on. An option contract with 4 weeks remaining will decay in value much quicker than that same option contract with 8 weeks. So that's the general concept, that fast time decay. So here's that example. You're long the 38 call. You paid $400 for it. You shorted that 38 call. You collected $100 right there. That's a debit of $300, right? 100 from 400. Stock trades sideways towards the March expiration. That 38 call is lower in value because of that time decay. So here's what it would look like at the close when you get closer into that expiration. Again, you were long that March 38 call, and its time decay, we'll say, didn't decay too much because it's further out, right? So that's called theta, so it's going to be less decay. But that short 38 call, that thing was cut in half, and it will even go to 0. So if you just took it off at 50 cents, then that spread became 350. So you put it on at 300, now it's increased to 350. That's $50 profit, or 16.66% return on your capital at risk, that $400. So that's the general concept there. And the advantage, it's a low capital commitment, and you can even go out and buy those leaps, which gives you some really good leverage. The loss is also limited because it's a net debit, and it doesn't require a lot of time to manage. The disadvantage is that, you could get, basically the main disadvantage is that you are limited to the underlying asset if it rallies, and the short call option could be assigned. But these are ways to around that. It's not that big of a deal. And the profit potential, again, without going through it anymore, is that you've got a defined risk type of trade strategy. So I like these, in certain situations, they're really good to do. Now here's just another example of that the time here. So you're basically see the 60 days out. So you'd buy the option there long, same strike, and you're going to be selling that 30-day out or closer to expiration. So you get that decay really quick. So that's the key component there. Now here's the next one, is a diagonal spread, and this is one I like a lot too. And this is for a situation that I just did one yesterday, a really cool one on GDX. But basically it's a calendar spread, but it's you have different strikes that you're using. So it's a version of a calendar spread, and all you have to do is purchase an in-the-money leap. So a leap is something that's an option that's a long-term option. You can go out a year, 2 years. And there's a certain way to set these up, but I'll go through a quick example just to show you what it looks like, and the benefit of it. So this is on a trade I did. If you have it's great for a bottoming type trade. If you see something that you think has potential to have a longer term move, such as a commodity like crude or gold or bonds or something, this is a great trade strategy. So I did this on USO and I did this on GDX just the other day. But so this example, USO was trading at $35. When I put this together, it was around $35. So what you do is you buy to open. I'm using 10 contracts. The USO January 2015 calls. That's a year out basically, and you buy those at $25. And there's a certain way you set this up with your delta and stuff. I can't go through that today. And then you sell 10 option contracts of the at the money USO March 2014. So you're selling that closer in strike, and you collect $60, 60 cents or $60 a contract. So here's the return to show you how it works just from this example. So you've got that credit you received, the 35 March calls, 60 cents or $60 per contract. So that goes in your pocket, right? And then you'd bought the January 2015 $25 calls at $10. So that's $1,000 per option contract. So here you can see your debit. You paid $1,000 for that underline, pretty cheap, and you received $60. So that's a $940 credit. If you just took that $60, if it went to zero from time decay, right, and it expired worthless, then it's just like a covered call, but your underlying is that long-term leap, and that capital cost is only $1,000. So that's a 6% return in about 4 to 5 weeks, and that's a pretty nice little annualized return. Now, if you'd done the stock instead, here's what the stock would look like. You bought, you sold that March call. This would be a cover call situation at $60 you received, but you bought the shares of USO, the ETF, and they were at $35 a share, and you'd buy 100 shares to make that equivalent, to make apples and apples. So that's $3,500 for 100 shares. So you take your $3,500 minus the credit. You can see your debit here was $3,440 on 100 shares. Now here's your return, $60, but your capital cost was $3,500. So you only made 1.7% versus 6% here. So I love these type of trade strategies for the right situation. Now, if I have time, I'll come back and show you the GDX trade that I did yesterday. I got 9% on that trade, and that is a trade that you'll sit there. You don't really have to do anything. It just, once you put it on, you just sit and you let that time just chip away. So the other strategy 4, are your credit spreads. And there are two basic ones, the short vertical spreads and the iron condors. And if you're not familiar, all a short vertical spread is, you've got the bear call credit spread, and that's long a call and short a call against it, same month. And then you've got the bull put credit spread, where you're short a put while simultaneously long a put with a lower strike. So these are the two basic credit spreads, and these are the ones I like to use. So they're a low-cost directional play, basically, and so it helps to have a good trading model or directional trading system, which I do have, to help you set these trades up. So when constructed properly, this spread is an excellent premium collection strategy. This is my favorite ones to use. And Karen, the super trader, this is what she uses. So everybody's probably heard of her by now. And these are credit spreads. So the maximum value of the vertical spread will equal the difference between the two strikes. Therefore, the seller will have a limited profit but a limited loss, and depending on which strikes you use. And the bear call credit spread can make money over time even if the stock stays stagnant. So these are key concepts that you need to understand, is when to use these things and how to use them. Now then, the long iron condor is just the combination of the bull put credit spread and the bear call credit spread. So that's the difference now, and this is kind of a non-directional type of trading strategy. So again, the iron condor is ideal strategy for premium collectors who seek to minimize potential losses in the event the stock moves adversely. And this strategy also takes advantage of volatility collapse, especially when you're playing this to option expiration or for earnings. And it's broken down again into 2 trades. So you want to use this if you're trading in a tight range, where the market's not going up or down on you. This is a great strategy to incorporate. The hard part is to know, okay, when are you in a sideways market, and what happens if it does break out, and runs over one of your spreads. So these are things that you need to understand for long iron condors. I prefer generally just to use a credit spread, either a vertical call spread or the vertical put spread. And long iron condors I like to do on the CBOE index type indexes, which give you some really great advantages for this type of setup. So these are the basic income strategies that you should look at. Here's what a long iron condor looks like. You've got this premium here, and then you're capped at your loss. So it's a good concept. Now the key to all these strategies is what is known as implied volatility and your standard deviation or a normal distribution curve. So if you're familiar with option trading, this is something that you need to understand how to use, this bell curve. So I just wanted to throw that out there, and this is the key to credit spreads. This is the key right here, a bell curve. And I will go into more detail in that a little bit later here. So in summary, today I just wanted to go over how not to lose money trading options, why your brokers won't let you trade options, the components that every option investor must understand, and the most important option factor for income generation as a goal, and some of those income strategies for you to look at. Now let's talk about how you can learn more on successful option income strategies and some simple things that you can start doing now to generate a steady income stream each and every month. But before I get started there, I wanted to I've had a lot of people ask me, well, how can I start making money, and taking my trade to the next level with some of these strategies that you're talking about. And before I go further, I want to show you this next slide. This is I put on an income strategy a webinar to teach all these strategies in depth about 2 weeks ago, and this is an email I received from one of the members that came to it, and it really made me feel good because as an educator or teacher, one of the biggest things is to have success from your people that are you're teaching. And I got this from Charles in Missouri. He says, "Thank you for the wonderful credit spread option course you delivered this week. The class was so thorough and expansive on the immense flexibility of credit spreads. Before your class, I was not aware of all the creative ways to defend credit spreads as you gave such a, I like this," he said, "a Swiss Army knife list of compelling defensive tools. Thanks again, Larry, for your effort to help traders. It's so inspiring to hear an option professional with your vast experience helping others up that ladder to a new level of understanding on credit spreads and risk management." So that really made me feel good, and it's kind of what inspires you a lot of times to keep moving forward. So that being said, I wanted to make this offer to you guys today, and this is what this is the course that I did. It's a 4-hour trading course strictly on credit spreads, and the beauty of this is it's only $97. So you can, right now, today, you can see if this is something that works for you, and it's going to only cost you $97, which is not even, you can't even go out for dinner for 2 on $97 unless you're just, going to McDonald's. So this is a 4-hour course that I did on income option trading, primarily credit spreads, and I go through just all the defensive measures, like the guy said, a Swiss Army knife approach, and I really thought that kind of summed it up. So I want you to go to this URL, and I'm going to keep this open, through today and tomorrow, but it's $97, and it's let me get a sip of water, sorry. And it's powercycletrading.com/buy. And let me just go through. I don't have a lot of time left for questions, but with this course, it's over 4 hours, and it's all, like I said, on credit spreads. So this is what's going to be covered, and it's power cycle trading. If you could post that. Thank you very much, Chris. This is what's covered. How to use credit spreads to create low-risk, high-probability trades. How to use credit spreads on stocks and index options. This is a key. SPX, NDX, OEX, RUT. And how to use non-directional credit spreads and when to use them. It's not all the time that you want to use them. Sometimes, you want to use a credit spread when the market's up, when it's down. How do you do that? So this course at powercycletrading.com/buy will teach you this, and it's $97. So even if it's a way for you to learn something for a very little investment to see if it works for you, and then you can go forward and really get into it. And this course also teaches you how to steadily and consistently grow a small account through credit spreads. And the big thing, how to defend those trades. Now this is the big part of it, and like that guy said, I have all these defensive strategies like a Swiss Army knife, all lined up for you, step by step by step, and when and how to use the iron condors. I'm not going to use an iron condor all the time. I prefer, like I said, to use the credit spreads, either the bull put or the bear call, and then I'll teach you how to take a credit spread that has a 70 probability of winning and turning that into 90% probability. This right here, this one thing right here is worth $97 for me anyway. If I can have something that's 70%, that's awesome. But if I can take that 70 and turn it to 90, that's pretty incredible. So that's what you get, plus how to use the iron butterfly, step-by-step guide for executing the spreads, what technical analysis techniques to use at. This is one of the key components, the technical analysis. That's what I'm big at. That's what I'm good at as well. How to use the power cycle trading model. This is the directional model that we use. So just go powercycletrading.com/buy and get your opportunity now for $97 to learn everything about credit spreads to see if it's something that works for you. And the best market times for the spreads. There's not always, the markets have different time frames that you need to know about. And then, how to trade the spreads end of the day, so you don't have to be bug-eyed looking at the charts all day. And there's a lot more. So again, this is a 4-hour course. You get all the recorded modules plus the PowerPoints from this, and all you have to do is go to powercycletrading.com/buy. So, don't miss out on this. It's a great opportunity, and if you get in now, while it's open, you can take advantage of this. So I appreciate the time that you allowed me to have today, and I hope that everybody was able to take away something from this they learned. If you're familiar with options, maybe there are a couple of these strategies that you're not using that perhaps would be good for you to use. And then I really hope you'll take advantage of this powercycletrading.com/buy for $97, hard to beat, and you can learn about these strategies in a lot more detail than I can present to you today in 40 minutes. So again, thank you very much, Chris and everybody, for having me. And everybody have a wonderful weekend, and good luck trading next week. And I hope to see you at Power Cycle Trading. Thank you very much.
All right, Larry, thank you so much, sir, for joining us today in the webinar. Just want to let you guys know that's powercycletrading.com/buy, www.powercycletrading.com/buy.